Interest rates are rising once again after remaining low for many years. But what does this mean for those who invest in real estate investment trusts or REITs? In this episode, we take a look at rising interest rates and how this will affect REITs. Please do drop us a follow if you would like to keep in touch with topics like these. As we know, REITs are vehicles that own real estate assets. As an investor in REITs, you are entitled to receive a large part of the rent collected from these assets in the form of distributions. As long as the assets continue to collect rent, investors will continue to receive these distributions from the REITs. But in environments where interest rates are rising, REITs may be negatively impacted for the following reasons. Firstly, the major impact will come in increased borrowing costs. REITs often rely on debt to finance their property acquisitions and operations. When interest rates rise, borrowing becomes more expensive, leading to higher interest expenses for REITs. This can reduce their profitability and cash flow, as a larger portion of their income goes towards servicing debt. Secondly, there will be higher opportunity costs. Rising interest rates make fixed income investments, such as bonds and fixed deposits, more attractive to investors. As a result, some investors may shift their funds from REITs to these alternative investments, seeking higher yields with lower risk. This increased competition for capital can lead to a decline in demand for REITs and put downward pressure on their stock prices. And thirdly, is the impact from falling property values. Higher interest rates can lead to decreased demand for properties as mortgage rates rise, making borrowing more expensive for investors. Reduced demand can result in lower property values, which can indirectly impact the valuations of REITs and their underlying assets. However, having said all these, it's important to note that the relationship between interest rates and REITs is complex, and other factors can also influence their performance. Different types of REITs may be affected differently by interest rate changes, depending on how they structure their loans. Additionally, REITs with long-term lease agreements or inflation-protected contracts may be better positioned to withstand the impact of rising interest rates. So, in environments with rising interest rates, it may be prudent to look out for REITs with good loan covenants, long or inflation-adjusted rents, and are operating in relatively more resilient sectors. If you found this video to be useful, do drop us a like and subscribe. And comment below with further topics that you would like us to address.